So there's no investment strategy that works every day, but is there a strategy that seems to work best over all the days? The magic of dividends in today's Coleman Wealth Academy, coming up. So today we're going to talk about dividends and why I believe they provide, I think, one of the most important foundational pieces in every portfolio. So let's just get on the same page. What are dividends? So dividends are what we receive by being the owners of a business. So when we own a share of a company, whether it's Royal Bank or McDonald's, when we own the business, one of the things that can happen is that as the company has revenues and profits, they can pay out some of those profits to those of us that are shareholders. Now, not every business should or can pay dividends. Frankly, the company has to be profitable in order to pay dividends, but not every company should. So high growth businesses generally will retain the returns that they generate and reinvest them back into the business so they can keep growing at a really fast rate. Technology businesses or biotech businesses, for example, would be in that category. But I believe that when you build a portfolio, you ought to start with a foundation of really healthy, mature, strong, great businesses that organically generate a really high amount of free cash flow and profit that can be paid out to you as a shareholder. Because the longer you invest, the more the dividends become a critical part of your return. So when we invest in something, and this is very similar to how a landlord would own a business, is that we really want to get kind of two components to our rate of return. The first thing is, what price did I buy it for? And hopefully that price appreciates and I can sell it for more in the future. But then also, what earnings did I get from owning that security over that time? So if I'm a landlord, hopefully I bought a property that goes up in value, but then how much rent did my tenant pay me over time? And was that rent growing through time, right? Because $1 20 years ago is not going to be the same as $1 today. It's not going to buy as much today. So when we look at buying a company or investing in a company, I want to also pay attention to what price did I buy it for? Hopefully I can sell it at some point in the future. But while I'm owning it, do I get the benefit as an owner of receiving a share of those profits paid to me on a regular basis? So that's what dividends are, and I think why they are important. But let's actually dig into some of the history of why they are so important. So the first chart I'm going to show you here, and I'm going to use both US and Canadian data. So for the US data, I'm going to use the S&P 500, which are the largest 500 companies in the United States. And for Canada, I'm going to use the largest 300 companies that are in Canada. So the first chart I'm going to show you is what happens if we look at just price change over a period of time. So this chart goes back to 1960, and we get to $10,000 invested in 1960 grew to be worth $800,000 approximately by the end of 2021. And that's assuming we didn't get any dividends. Now, if we add the dividends in, you can see that, as I mentioned earlier, the longer you invest, the more important dividends become. So if we reinvested those dividends back in, so we taken the cash we got and bought more of the companies, we didn't have $800,000. We had just shy of $5 million. This is why I say it's the magic of dividends. Canada, very similar story. Not going to go back for the same length of time. We're only going to go back to the 1970s here, but still, same example. Instead of $10,000 being worth $210,000, if we got the dividends and reinvested them, it's worth $800,000. So pretty substantial distinction between getting no dividends and having the dividends. Now, when we look at companies, by the way, there's another factor that we have to consider, which is sometimes some companies pay very high amounts of dividends. Other companies pay a smaller amount, but it can grow through time. So one of the things that I believe is we want to invest in companies that are organically strong. Obviously, we want to invest in healthy, growing businesses, right? That makes sense. You don't have to have a Nobel Prize to know that's probably a good idea. So it actually proves to be very, very true. So if we look at another chart here, which shows companies that had to cut their dividends, that's not good. That's a sign of a business that's not healthy at all. You can see that's probably been one of the worst performing strategies, is buying lousy companies. That shouldn't really be a surprise to anybody. Or companies that don't pay any dividends at all, also not great. But companies that have, I'll just focus on the top two lines, companies that pay dividends versus companies that are growing their dividends. Now, there is a class that I really like to invest in. It's kind of boring, but boring works. You know me, right? Boring, we like boring. Are companies that are actually called dividend aristocrats. Now, you've heard the term blue chip companies, right? Blue chip companies are mature, healthy businesses that often pay lots of dividends. Within that, there's a class of companies that have the best history of not only paying dividends, but raising them through time. And those are called dividend aristocrats. And they're not really blue chip companies, they're almost purple chip, as you could nickname them, because they're royalty. So we like to own those kinds of businesses. And it's not just because they tend to do better over time in terms of making us our returns, but they also do another magic trick, which is that they tend to reduce risk. So I'm going to show you another chart, and this is using, again, American data. If we look at bull markets and bear markets, if we look at the companies that are dividend growers and companies starting to pay dividends, you can see that in bull markets, they tend to do pretty well. They don't do as well necessarily as the guys who don't pay dividends. Again, that would be like technology stocks. And certainly we saw that kind of in the early part of 2020 when the pandemic set in and all the companies that helped us work from home, all the technology businesses, they generally don't pay dividends. So they surged like crazy. Well, that's great, but you can see that if we just step back for a second and own the dividend paying companies, the more mature businesses, we didn't really give up a lot, right? But look what happened on the downside. In bear markets, those dividends really do help to protect us. And we can see that over all of the days, we tend to get the best risk-adjusted return. And that's also very true when we look at Canada. So again, I'm going to show you the same type of chart for Canada. If we look at the companies that pay dividends but then grow them through time, tends to be the best performing category if you're patient, and we like to be patient. And they also generally have the lowest degree of volatility. They don't bounce around as much. And again, because they're generally healthier, stabler businesses. So this to me makes a lot of sense. And as I said earlier, the longer you invest, the more the dividends make up part of your return. And if we go back and look at decade by decade, you can see that in every decade, dividends made a difference. Indeed, if you look at the 2000s, to highlight that one for a moment, that was actually considered the lost decade because the Dow Jones went from 10,000 to 10,000. So in 10 years, it didn't go anywhere, which isn't really true because it went all over the place. It bounced like crazy, but from point to point, it didn't go anywhere. So if all you had were price appreciation, you didn't make any money in a decade, but the dividends tripled during that time. So the dividend income was really what you had to have to provide any return. And we can see that over a very, very long period, from 1930 to the end of 2021, the dividends were about 40% of your overall return. And as we saw, if you reinvest those dividends back to buy more securities, more healthy companies, your returns are absolutely tremendous. Now, a question I sometimes get is, well, Darren, we've got inflation. Our dividends going to hold up well in that environment? They are. Dividends generally go up at a rate faster than that of inflation. And can companies keep paying them? Well, part of the ability to pay is companies have to have good margins and have good cash on their balance sheets to pay the dividends to shareholders. And if I look at the next chart, you can see that as of like the end of 2021, companies had record amounts of cash on their balance sheet. So the companies that can pay dividends, I think generally are going to keep on doing that. Now, obviously you do have to look for them. We do have to pay attention, and we can't just buy anything. We do have to take our time and be careful about which companies we buy. But what's also very interesting there is you just have to get average. It's really interesting how B students, if you will, tend to do pretty much better than anything else. So when we look at which quintile of companies did the best, it's actually, believe it or not, the guys in the middle that are just above average tended to have the best performance. So we don't really, I think, have to try overly hard to find great companies. As long as they're above average, we're going to be fine. You don't have to find the top 2 or 3 or 5 to do well at this. You just got to kind of be mostly accurate. So just get the ball close to the pin and it's going to be fine. So there's my short course on why dividends, to me, provide, I think, one of the best foundations for every portfolio. And they're certainly why they're a hallmark of how we invest. And I really think that for most investors, they're really the secret weapon to have good returns over time, have an income that rises at or better the rate of inflation, and kind of make sure you have a really healthy portfolio because it starts by buying healthy businesses. So that's your course for today. As always, no exam, just good stuff to help make you a better investor. Stay tuned. I have more episodes coming up. Thank you very much for watching.